India's budget versus rising oil prices, and why rising oil price is a critical risk to India's budget. Let's discuss this topic very simply. Petrol prices affect much more than just what we pay at the fuel station. When petrol prices rise, we feel it immediately. But what many people don't realize is that it also affects government budgets, stock markets, and even the value of our money. Right now, one global issue is quietly putting pressure on India's economy, as rising oil prices are being driven by tensions around the Strait of Hormuz, one of the world's most important oil routes. So, first, let's understand what is happening to the oil prices. Global oil prices have recently crossed $80 per barrel. This increase is not because oil is running out, but because markets fear possible supply disruptions in the Middle East. In fact, even the possibility of supply disruptions and uncertainty in this region can push oil prices higher. But before going further, there is one important clarification. Petrol and diesel prices in India have not increased yet. This is because fuel prices are often controlled and adjusted slowly. However, higher global oil prices still create pressure in the background, affecting government finances, inflation, and future price decisions. So you might be wondering, if fuel prices in India have not increased yet, why are we discussing this now? The reason is that oil affects the economy before it affects petrol pumps. Governments, markets, and currencies react first. Petrol prices usually change later. By the time people see higher prices at fuel stations, the damage to inflation, the budget, and the economy may have already begun. Now let's understand another important point: what the budget actually assumed about the oil prices. India's latest budget and economic planning were made assuming that oil prices would stay around $70 per barrel. This assumption matters because oil prices affect inflation, government spending, and economic growth. When oil stays higher than expected, those budget calculations start to break down. So, why do higher oil prices hurt the economy so much? Economists have warned that if oil prices stay above $80, inflation in India could increase by about 0.4%. India's trade gap with the world, called current account deficit, could increase by 0.3% to 0.5% of GDP. In simple terms, India has to spend much more money just to buy the same amount of oil. Now let's see why India is particularly vulnerable to this problem. India imports more than 80% of its crude oil from other countries. A large portion of this oil passes through the Strait of Hormuz. So when oil prices rise globally, India's import bill increases, pressure builds on government finances, and everyday costs rise for businesses and consumers. But the impact doesn't stop there. It also affects the currency and financial markets. Higher oil import means more dollars are needed. This puts pressure on Indian rupee, which has already weakened recently. A weaker rupee makes imports even more expensive, creating a cycle that adds further inflation and worries investors. That is why stock markets often fall when oil prices rise. And there is another possible risk that economists are watching closely: investment and growth risk. Economists and global agencies have warned that continued conflict in Middle East could reduce foreign investment to India. That could mean slower economic growth, fewer new investments, more pressure on budget targets. These risks were not fully visible when the budget was prepared. So what does all this mean in the bigger picture? India's budget was planned assuming stable oil prices, but oil prices are now higher because of global tensions. If this situation continues, the government may face tougher choices on spending, inflation control, and economic growth. This connection between oil, geopolitics, and the budget is important to understand. If you have any questions or doubt about this topic, please let me know in the comment section. This is the Simple Take, important boring things explained simply.